Okay, we're getting to be live. Getting ready. Hang on.
Says it's on. Says we're live.
Okay. All right. I think we are now live. Okay. Hello, everybody. It's Halloween week, Tuesday. I'm here with two of my very good friends and colleagues, Jacob Schrader from where in Ohio?
Oh, Fountain, Ohio.
Bellefontaine.
Bellefontaine, as the people from the South say, and with Beth Melcher from Traverse City, Michigan. Beautiful Traverse City. Are the trees still looking good up here, Beth? Tuesday.
Yes. They're covered in frost and snow today, though, a little bit.
Oh my goodness. Okay, so it's Halloween week, and we thought that it would be fun to kind of do some Halloween themed accounting talks this week. I have often heard, and I would like some feedback from you, Jacob and Beth, that the balance sheet can be one of the scariest financial parts of the financial statement, and it's where the bones are buried. Why do you think people say that? And why is, all scary things aside, why is the balance sheet an important part of your financial statements? Jacob, you want to jump in first?
Yeah, the balance sheet's a super important piece, simply because it is the one thing we can tie out as a point in time, right? So the balance sheet, we can tie every account out there at a certain point in time. You know, it's the balance sheet at the end of last month. Well, we can tie out cash, we can tie out accounts receivable, we can prove out each of those. And it's super important because if we have a good beginning balance sheet and a good ending balance sheet, we always know that the difference is net income. So that is why we always say it's the most important piece. I also say this is where the bones are buried because it's a balance sheet. It starts when your business begins and it continues up until this date. It never gets cleared out like a profit and loss does or an income statement does. So therefore, all of the bad acts in the history of the company are buried in there somewhere, right? And it's all hidden in there at some point.
Good points on that. I often, when I'm trying to explain financial statements to either new bookkeepers or staff accountants or to clients, you know, because clients, they didn't start a business necessarily because they understand financial statements. I tell them it's the history of their company, that from the day it's born until the day it's either closed or sold away, it is the life of your company. Beth used to be in the banking industry, and I know a balance sheet is important when our clients are going to apply for loans, lines of credit, things like that. From your banking background, what did y'all look at? What were flags, maybe scary flags you would see on the balance sheet?
Okay, so first, true sign of a Facebook live streaming rookie, I did not clean up my background. I completely have a hanger right there. Note to self for next time.
Waiting rookie. For your Halloween costume.
Rookie. So I love working with small business owners because I love their P&Ls. It's like sales, woo, and margin, woo, and net income, woo. And then balance sheet, they're like, I knew there was another piece of paper on the back. What's that for? And the bankers look at it because understanding how highly leveraged, I'll explain that in a sec, a company is really important to be able to determine if the company is going to be viable in the long run. I just had a call today where one of my clients was saying, hey, I'm thinking about getting another loan for another truck. And we looked at the debt portion. So on a balance sheet, you've got all of your assets on one side, and you've got all of your liabilities and your equity on the other. Most business owners in my world understand that if we explain it like it's your house, right? You've got your house is worth, let's say, $300,000. And you have a mortgage of $200,000, that's your liability on it. The house value, the 300 is the asset. The difference is your equity position, right? It's the $100,000, the 300 asset, minus the 200 liability is the 100 equity. The balance sheet's no different. So once we can explain that to the business owners and get them like over the bridge to go, oh, that's all the balance sheet is. It's like, I want someone to explain to me what a carburetor is someday, because like, the word to me is so scary. I have no idea what it means, but I think if someone explained it, I'd be like, oh, that's it. So we look at it because there are times where, I mean, people have always talked about being upside down in their houses, meaning they have more debt on the house than the house is worth. Your company can flip the same way. So bankers will look at it and say, man, this guy's got way too much leverage. This gal's got way too much leverage. Plus, if you ever want to sell your business, the only thing, not the only thing, but one of the major things the purchaser is going to look at is the net equity that you have in the business, the assets minus the liabilities. That's one portion of it that's really important. I could go on for days, but maybe someone wants to go over some of the, like the current stuff that's on the balance sheet. I thought I'd tee that up for someone else.
No, it's good. I think the liability section is very, very, very important because it does show the financial health. Your P&L can say all kinds of great sales and low expenses, but if you're servicing so much debt every month, it's a big portion of it that you're missing. Let's talk about the equity section. So Jacob is, in addition to providing client accounting services like Beth and I do in our companies, Jacob is also a tax CPA. The equity section, it's not always maintained properly, but when does that become an issue? When does that become scary when it's not been done right?
So the biggest thing from a tax perspective in an equity section is when you take more money out than you have in a company, in the equity of a company, right? So we really start being concerned about what we call negative basis, which means, the amount of money you put into the company plus the amount of money the company's made minus what you've taken out. If you're taking out more than what you've put in and the business has made, we're running into issues because now you are taking money out that is financed with debt, right? So you're basically taking a loan out in the company, it's in the company's name, but you're taking that money personally and utilizing it, which obviously should be considered income to you personally. It's debt to the business, but income to you personally. So that's one of the biggest issues we see in a business for sure, is especially small businesses where people feel like they can just take the money out of the business and we're taking draws all the time because that's how they're paying themselves. Well, they really have to watch, are we taking too much out, right? So that's one of the scariest things for me in an equity section, right? It's also, when I'm analyzing a business, if I'm seeing a large negative equity section, even if they're not taking draws, I instantly have a red flag about the viability of this business long term, right? Because if our equity section is underwater, to Beth's point before, when your house is way underwater, this is what caused the financial crisis. People had way more debt on their house than the value of it. Once again, if we have way more in liabilities than we have in assets, that speaks to the long-term viability of a business, and it raises concerns about the ongoing ability of a business and how long they're going to be able to operate that way. So for me, the equity section is like the red flag right away of what's the health of this business. And obviously health of a business goes into a lot more than just the equity section, but that's a real quick flag if it's negative that we're going to have an issue.
Hey, Amy, how would bookkeepers and accountants who are managing books for clients manage that section well for their clients, the equity section, when they're doing maybe month-end close or doing a chart of accounts setup? What would the approach be for that?
Yeah, we were just talking about this last week, that your equity section should reflect the type of tax entity that this business is. It's set up specifically with specific account names if you're a partnership versus a C Corp or an S Corp, or if you're a sole prop or a DBA. So you're going to use specific terminology. You're going to use contributions, distributions by partner if it's a partnership. You're going to have some equity accounts like additional paid in capital, common stock, preferred stock if you're an S Corp or a C Corp. So I would work, if I was setting up a file from scratch, or if I was coming in, taking over a file, the first thing I'd want to see is, let's see that last year's tax return. Let's work with the tax CPA to make sure that section is set up the way they want to see it and be clean, clean going forward. That's a good way to segue into the last section we're going to talk about scary balance sheets. I want to go first because I have such a good one, but I'm going to be good. What is the scariest account that was totally messed up that you've seen on somebody's balance sheet? Beth, you get to go first.
The scariest account on the balance sheet is probably uncategorized assets. if that's what we mean, like if you're saying like which line item on the balance sheet, sometimes there are accounting softwares where the kind of the AI, the little bot inside of the computer or the software is trying to help you. So when transactions come in, they'll sometimes automatically book to a line called uncategorized assets. And people who don't monitor their bank feeds very well, meaning they assume that what the bank is recommend or what the software is recommending is the correct categorization, they'll push those transactions into uncategorized assets. That line on a balance sheet means absolutely nothing. There have been times when I have seen $75,000 in that at the end of the year. And who, I mean, if a client's been running all year, the $75,000 parked in absolutely the wrong place. So that's the one that scares me the most.
Yeah, and it does need to be cleaned up. Most of the time when I see that one, like you said, it's a software issue. It's whatever platform you're using. It forces you to stay in balance, and that's the account, one of the accounts it uses. Jacob, what about you?
I think the scariest for me is probably undeposited funds.
Oh, I knew you were going to steal mine.
How did you take yours?
But and I think it's the scariest because I see it get used improperly so often, right? And it leads to a lot of other issues. Because typically if it's used incorrectly, we also have a major problem in the P&L, which is income's completely wrong. We also have a real impact on cash, which if that carries forward over multiple years, now not only was our income statement wrong multiple years, our whole balance sheet's out of whack. And it's, once again, I feel like undeposited funds many times goes back to a software issue because people don't understand how their software should work and how they should be leveraging undeposited funds. You know, on the simple base, your undeposited funds should be the old bank bag that you have, right? Like you received all the checks, they get stuck in the bank bag, you take it to the bank, and now we move it from the bank bag, undeposited funds, to the bank account. But too often people don't really understand that process and they end up duplicating income as well as missing a lot of other pieces.
Exactly. I had a scary cleanup job years ago, and for 4 years they had been double counting revenue, and the business owner couldn't understand where all their cash was. Well, it was, and they'd been paying too much tax on that, of course, too, which so. Correct. We were glad to help them get straightened up, but it was definitely some training. That is my scariest account too. You just have to watch it. I would also say that many of us are modern accountants and we use all kinds of apps to connect our point of sale systems and things like that. When you're hooking one of those up, be super careful. I have seen with lots of e-commerce cart connectors, it will duplicate your efforts. You will have 2 sales, even running through undeposited funds. So be real careful with that and watch that when you set up that syncing technology.
So do you guys reconcile? Tell me about your monthly process. I mean, I think that it's really important to at least soft close all of the line items on your balance sheet at the end of your month.
Yeah, absolutely.
You should be doing some sort of review on that on a monthly basis for sure. I mean, you know, with every agreement, you may not be doing things on a monthly basis, depending on your agreement with the client, right? But whatever your engagement period is, once again, a balance sheet is a balance sheet and you can tie out every account on there, right? So you should be able to tie the balance on that. That's why it's called a balance sheet, right? That is the balance in that account. And really, if you're an accountant, you should understand what makes up that balance. Because if you can't prove that balance, then it might not be right. And you know, this goes back, like if you're in the audit world, they truly go through each one of those accounts and say, we need a full schedule for each of those. So, I mean, depending on what your engagement is and the level you're going to, at bare minimum, you should at least be reviewing that account on a monthly basis. Even if you're saying, I don't have the skills to maybe reconcile it completely. I'm just a bookkeeper. I don't want to be there, which I hate that term, just a bookkeeper. But
yeah,
if that's what you want to say to yourself, okay, that's fine. But at least be reviewing that for reasonability, which is something you should be very capable of, even if you feel like, okay, I might not be able to go all the way.
Agreed. And if you are a bookkeeper who wants to take their skills to the next level and you hang out in the transactional world, which is so important because it's the base of every number on a set of books. If you want to take your skills to the next level, post all of your transactions through it, get that P&L nice and clean and tight, and then hop over and look at the balance sheet. It's where I start my review every month. If I'm not into the detail, the balance sheet tells you so much. And it's also where I start when we're talking with potential new clients. I want to see that balance sheet before I don't really care about the P&L at first. I want to see that balance sheet. I look for accounts. There's only a handful of accounts that should have a negative balance. Your other accounts on your balance sheet should not be negative unless there's a good reason for it. If it's not a contra account, if it's not some sort of, I can't think of it, the one that's with the debt discount account, the debt discount, all your accounts, all your accounts should have positive balances. Check a look at those prepaids, really take a look at those undeposited funds. Okay, we promised ourselves before we hit live that we were going to stick at 15 minutes. This has been good discussion. Before we sign off and tell everyone to have a happy Halloween week, Jacob, Beth, tell us where we can find you online, on the socials, and what your website is. So
I'm on Twitter at Jacob B. Schroeder, SCHROEDER, and my company website is ascendllc.com. Okay,
thank you. Beth?
My name is Beth Melcher. You can find me at bemoneyfit.com, BEMONEYFIT.com. And my Twitter is at Beth Melch.
Wonderful. And I'm Amy Walker in Houston, Texas. We are a mighty client accounting services firm. You can find us at walkeragency.us. And on all the socials, we are Walker Agency, and that L is the number 1. Thanks so much. See you guys next week.